Hey everyone, and welcome to The Explainer. I am so glad you're here today because, well, we're tackling a subject that is quite literally hitting all of our wallets right now. Just when it looked like things were finally calming down, rising prices have stepped right back into the spotlight. So today, we're breaking down a super practical, incredibly timely checklist from Fidelity Investments titled How to Beat Inflation 10 Tips. We're going to look at some proven, structured ways to protect your hard-earned money and make sure your financial strategy is actually working for you, not against you, in this kind of environment. Okay, let's dive right into this, because the data paints a pretty clear picture. Back in March, U.S. consumer prices rose by 3.3% year over year. I mean, that is a noticeable jump, largely being driven by higher energy costs and other daily expenses just, creeping back up. We aren't just talking about abstract economic theory here. We are talking about a real shift in what it costs to simply live your life and run your household month to month. Just to ground that abstract percentage in reality for a second, gas prices alone are up about $1 a gallon from a year ago. A whole dollar. When you multiply that by a full tank and then by the number of times you're filling up every month, you can see exactly why household budgets are feeling this squeeze. It's these everyday friction points that make inflation so incredibly frustrating. But here's the thing. Beating inflation isn't just about picking the right hot stock, and it's definitely not just about clipping coupons. According to Fidelity, it requires a two-front strategy. On one side, you've got to play defense by protecting your daily budget against those rising costs. And on the flip side, you have to play offense, making sure your investment portfolio has enough growth potential to outpace inflation over the long haul. So, here is our roadmap for today's explainer. We'll look at the inflation squeeze, defending your daily budget, optimizing your savings, investing for growth, strategies for retirees, and finally, revisit, rebalance, repeat. Let's get to it. Section 1. Defending your daily budget. I really want you to ask yourself right now, where exactly is inflation hitting you the hardest? Because it doesn't hit all categories equally, right? Housing, food, insurance, and transportation often rise way faster than that headline 3.3% number we saw earlier. So your first step is to look back at your last 3 to 6 months of spending to find your personal inflation pressure points. Usually that's groceries, gas, and utilities. Once you track it, you can target it. Then try to lock in costs. Inflation hurts the most when prices just keep resetting upward. So get on the phone, renegotiate those recurring bills like internet or cell phone service. And if you own a home, a fixed-rate mortgage is a fantastic tool to keep your largest monthly payment completely stable, totally shielding you from rising housing costs. Section 2. Optimizing your savings. Okay, so there is a major hidden danger to idle cash. Obviously, building a robust emergency fund covering 3 to 6 months of expenses is foundational. We all need that. But if that cash is just sitting in an account earning 0% while inflation is running over 3%, you are silently losing purchasing power every single day. That's exactly why a dollar doesn't go as far as it used to. You've got to shift from idle cash to working cash. Fidelity suggests looking at vehicles that can adjust with interest rates. Think high-yield savings accounts, money market funds, or short-term treasuries. You want your cash to be safe, absolutely, but you also want to take advantage of higher yields to cushion the blow of inflation. Section 3. Investing for growth. Fidelity notes a really powerful historical reality here. They state the growth potential of stocks has historically been one of the most reliable defenses against inflation. What this means is that younger investors who naturally have a longer time horizon until they actually need their money, well, they might already have a built-in inflation shield simply by having a heavy exposure to equities. But if you're a more conservative investor or you're getting closer needing that money, you have to be much more deliberate about how you fight inflation's impact on your portfolio. Now, what's really interesting is that not all stocks behave the same way when prices heat up. If you're looking to add inflation-resistant building blocks, history points to a few specific areas. Commodity producers, like energy and materials companies, often do great because they're the ones actually selling the raw goods that are going up in price. Value stocks can also offer indirect commodity exposure. And definitely don't forget real estate investment trusts, or REITs, which historically hold up really well because property values and rents usually rise right alongside inflation. But what about the safer side of your portfolio? Traditional long-term bonds can actually struggle quite a bit when inflation and interest rates rise together. That's because as rates go up, the price of existing longer-term bonds tends to fall. It's kind of like a seesaw. So to adjust your fixed income, Fidelity suggests being highly selective here. You might want to look at Treasury inflation-protected securities, commonly known as TIPS, where the principal value actually adjusts with inflation. Pretty cool, right? Shorter duration bonds are also a lot less sensitive to interest rate surprises than their long-term counterparts. Let's expand this into a global strategy. Tip number 7 is to consider international investments. The beauty of the global economy is that it doesn't all move in lockstep. Inflation trends, interest rates, and market cycles in Europe or Asia might look totally different than what we're experiencing here in the US. By adding non-US investments to the mix, you reduce your reliance on the American economy alone, which can really help smooth out your returns over time. This brings us to a really vital distinction when planning your offense, preserving value versus compounding returns. Look, it is incredibly tempting when inflation spikes to just throw all your money into pure inflation hedges, like gold. But gold doesn't generate earnings. It doesn't pay a dividend. It doesn't compound. Stocks, on the other hand, allow you to participate in the actual earnings of a growing company. Fidelity warns that investing too heavily in traditional hedges carries a massive opportunity cost during normal periods. A modest allocation to things like gold or real estate might help, for sure, but the core engine of your wealth over time still absolutely needs to be compounding growth. Section 4, Strategies for Retirees. When you stop working, the whole game fundamentally changes. You're shifting from aggressively growing your savings to making sure that money actually lasts for the rest of your life. But you still need growth to offset rising prices. Retirees should focus on maximizing inflation-adjusted guaranteed income. This means looking really closely at Social Security and, if possible, delaying when you claim it. Doing that permanently increases your inflation-adjusted benefit. It could also mean exploring certain annuities. Crucially, though, retirees must keep a portion of their savings invested for growth. You can't just go entirely to cash, or inflation will slowly eat away your purchasing power over a 20 or 30-year retirement. And, of course, you've got to review your withdrawal strategies regularly to stay flexible as the markets shift. Section 5. Revisit, rebalance, repeat. This gives us a really clear rhythm to follow. Step 1, revisit. Your budget and your portfolio aren't set it and forget it things. You need to actually check in on them. Step 2, rebalance. Over time, as some investments grow way faster than others, your asset mix will naturally drift away from your original plan. So, you need to rebalance to get back to your target risk level. Step 3, repeat. Inflation changes, interest rates change, and most importantly, your life changes. This isn't a one-and-done fix, it's a continuous cycle of good financial hygiene. We have covered a lot of ground today, from defending your grocery budget to strategically optimizing your stock and bond portfolios. Fidelity's research makes it incredibly clear that while we can't control massive macroeconomic forces, we absolutely have the tools to mitigate their impact on our lives, which leaves me with one final essential thought for you to consider today. Inflation is unpredictable, but is your approach. Take control, utilize these strategies, and make sure your financial plan is as resilient as you are.